here we are today with Joe Frazier with True Life. What's the formal name of the company?
The True Life Companies.
The True Life Companies. Okay, I almost got it. Good deal.
Yeah. Yeah.
So give me some background. How long you've been around? How did it start?
Great question, Wally, and thanks for having us today. So the True Life Companies, I co-founded the company with our CEO and one other gentleman about 24 years ago, the original company. And our initial entry into the real estate development, home building space was from the capital markets standpoint. So we were raising capital for home builders and developers all over the country. Then 07 and 08 happened, right? And we decided instead of, raising capital for others, why don't we start to put ourselves into our own transactions? And that's really what became the formation of where the True Life Companies has evolved to, from that point in time. While I'll come back to, the industry and what changed in 07 and 08, I'll bring that back in. But as a co-founder, we did everything, as a kind of an early startup, if you will. We started doing our first few deals, and I was the investor relations, part of the team, right? So I would get on the phone and I would call all of our high net worth clients on a deal by deal, project by project basis. We'd put the capital into an LLC, do the LLC's process, get the top, the project, the entitlements completed, and then sell the asset to top 10, top 20 publicly traded builder, right? From about 2015 to about 2018, we did 11 in a row, had great success with those. And that's what led us to decide to do things in a more formal way, utilizing the fund structure, the Reg D offerings, if you will, right? So we did our first fund in 2018, which meant I had to go back to school and figure out how to get my Series 7 and my Series 63 in my late 50s, which was not necessarily the easiest thing I've done in my life, Wally. So we got the company now with a licensed rep and our first Reg D offering back in 2018. Ultimately, that is Elite Fund 1. It's become our friends and family fund, which we'll talk about that when we get to the fund structure. But that led us to now having, instead of 11 transactions and 11 K1s and, kind of a disjointed capital stack in each of the LLCs, we've got one K1. We put the capital into the fund and diversify people across as many projects as possible when they invest with us. So that led us to doing Elite Fund 2 and then Elite Fund. So TTLC, Elite Fund 1 is the first fund. TTLC, which is the True Life Companies, TTLC, Elite Fund 2 and Elite Fund 3 in the regulated Reg D broker dealer space. So today, all total, that's about $150 million between the three funds that are currently invested across about 40 different projects, controlling about 4,500 housing units. So I can pause there and let you ask a question or two.
Yeah, so let's go up to 30,000 feet per minute. The overall market, what created the opportunity for this was the big builders not wanting to carry the land on their balance sheet anymore. They don't want a land bank. They need somebody else to be doing that. So,
that's correct.
Okay. And has it always been urban infill, or has it been kind of in the progress path, or how do you, what's your opportunity?
Yeah, great question. So we focus on urban infill. Here's our target. Our target buyer is a publicly traded home builder. Again, top 10, top 20 publicly traded home builders. That's who our core audience is, because they're building the first time home buyer, 3-bedroom, 2-bath product, right? In the Bay Area where I live and where the company was founded originally, that's 3-bedroom, 2-bath townhomes, 1,500 square feet, selling for $950 and sometimes more, right? Here in the core Bay Area. If we go up to markets like Sacramento, which is also one of our markets, it'll be small lot, 5,000 square foot lot, 200 square foot homes, but whatever that first time home buyer product is, that's what drives where we go. So it's not the farm fields like traditional land banking, how I think about it.
Right.
is, you buy the farm field, 3 farm fields from the border of the town, and you wait 10 years for the border of the town to meet that property, and now you've made a bunch of money on that land. Well, we're not that patient, right? And our investors aren't that patient, right? So it's a different model, traditionally core urban infill. And when you get into subdivision markets like Sacramento, it will already be in that underlying zoning within the city. Now we're just taking it through the process to get the final, final entitlements, but it's not way out in the middle of the farm fields.
In that urban environment, then, what size are the properties generally?
Typically a 2 to 5 acre site, and they'll be for 50 to 125 townhomes, right? So it's density, more dense, 20 to sometimes 24 to the acre. And it's the land planning and entitlement process that raises the value of the underlying asset. Oftentimes here in the Bay Area, Wally, those are old industrial buildings that might have been built in the 70s for the tech boom, right? There might be an old strip mall that, had a grocery store. Now the grocery store, is gone, and that value of that asset is dwindling. So we bring new value to it by the entitlement process.
Are they troubled properties, that they're brownfields, or things have to be cleaned up? Okay.
No, we don't do the cleanup. We don't do the brownfields. Technically, that's a much bigger, longer, arduous process.
Yeah.
In the Bay Area and probably in many markets, there's always going to be some level of some cleanup you have to do, right? If it wasn't, some asset, some building that was built on it's going to have some sort of cleanup, but they have exact processes and the builders here in the Bay Area, certainly, in Southern California markets where we operate, they're very familiar with what process we have to do to get through the entitlement, even if there was some contamination of some sort on the site. And that's really what we hire the experts to come in and evaluate in our due diligence before we decide to take it through the process and try to do the entitlements first.
Very good. Tell me about the locality then. Is it just California, or are you guys all over?
We're nationwide at this point. I'll just kind of give you let's call it 4 markets in California. We started in the Bay Area where I am. We have Sacramento, we have kind of Orange County and North San Diego County. Those are the core markets in California. We also have an office in Denver. We moved our headquarters to Denver in 2008, or not 2000, about 8 years ago when our CEO moved there. And so we have a Denver footprint. We're also in the San Antonio, Austin market with a few projects active, Raleigh, Durham. And then I think we're looking at Seattle and Salt Lake City as the next potential market. So call us in 8 metros, currently 4 or 5 different states. And, somebody invests with us today in the fund, they'll be diversified into every one of those states and geographic regions.
So I guess, for your part of the game, I guess it's not as worried about the legislative risk, the regulatory risk. You're not shy of, obviously, of the Bay Area or of Seattle.
Now, if we're successful here, which we are, we pretty much can handle most states.
You can do it anywhere. Yeah. Well, I don't know. Colorado might give you a run for your money soon. Who knows?
Yeah, well, we're hearing that from Colorado, and then we're also hearing that from Austin, right? Austin used to be a little bit easier to get stuff done, and now I call it, we've kind of Californicated it, so to speak, right?
Pretty much, yeah. Did you say Florida at all or not?
No, not in Florida yet. We've got a map that's got another 10 potential sites on there. I think in Florida, about the only one we've seen that looked interesting so far has been Jacksonville, but we have not ventured into Florida yet, right? So Raleigh, Durham, right? So there's our East Coast, if you will, and then middle of the country, Austin and Denver, and then we got the left coast, so to speak, pretty well covered.
So what typically is the minimum that you want to see from an individual investor?
Yeah, so the documents in Elite Fund 1 say $250,000. We've lowered that for our Emerson relationship, right?
Yeah.
And for full disclosure, I moved over to Emerson as a registered rep, right? So I'm utilizing these same projects and these products for my clients, but 100K is the minimum. The real goal of it Wally, is to bring, like the ability to invest in the residential real estate development space without having to take individual single asset risk, right? So if you put 50 grand in and you're spread across 15 projects, it's like a little mutual fund you don't pay any attention to, right?
Yeah.
If you put 100, 200, 300 grand to work in it, you'll see meaningful distributions and results, right? So it all comes down to, what's in the best interest of the client, right? So we work with our rep relationships from a True Life, wearing the True Life founder hat here, not my rep hat, to make sure that, that we get you as diversified as possible, whether it's $100,000 investment or $1 million investment.
So if two people come in at the same time and they each have 250 grand, are they going to end up in the same portfolios?
If they come in the same day, yes. If they come in a month or two apart, they could have very, very similar. There might be one that filled up for capital, doesn't need any more, or we might have onboarded another new project, right? And that's really the only difference, that the longer, the further apart they are from their investment date,
right?
The more varied their investment portfolio will be, but they'll be very, very similar.
How do you apportion it so there's some level of evenness, if you will? I mean, not that one project's a better project than another and getting overweighted here or there. How do you keep things fair?
Yeah, that's good. Great question. So we have one of our guys on the team named Chris Kaiser. Chris comes from an institutional endowment, investment relations background, family office guy. So really, really the smartest guy in the room whenever I walk in there with him, for sure. Right. So what Chris does for us, right? So he sits on our investment committee. He sits on the property team committee. He sits on the finance committee. He sits on investor relations. So he's literally involved in kind of every aspect of the company that touches an investment dollar. And what I proposed to Mike Colwell, at Emerson, when we started to bring Elite Fund One over to you and your group, Wally, and kind of having me play the wholesaler role, I said, I'm going to do this, but I want to make sure that I've got Chris setting up the investment allocation parameters, right? So every week he looks at the entire portfolio and he looks at, here's a new investor coming in, one of your clients comes in and they've got a $250,000 allocation. He's going to set that allocation, and then our formal office in Denver will ratify that. But basically he set the tone for that. The key there is, it's not a linear, if it's use 10 properties as an example, it's not going to be $25,000,
Sure,
times 10. It's going to be weighted toward the overall capital for that particular property. Each property has its own budget, and it's a kind of a pro rata share, appropriate share of that budget is how it's actually allocated. That way we're not cherry picking, because every time you cherry pick in this industry, you're wrong.
Right.
So we try to minimize but we didn't want it to be just a flat, split it over, 10 properties. That way it's weighted on the budget per project and it's a pro rata share.
What's the range of, well, let me back away from that. Explain how people are not buying equity. People are buying an opportunity.
Yeah.
Can you flesh that out a little bit, please?
Sure. So what you mean by that, Wally, is when a True Life Companies goes and takes on a project, decides to put one of their projects into the fund, it's not that we're going to spend $10 million and buy that asset. What we do is we put an option contract, a purchase and sale agreement, a legal contract here, whatever state we're working in. That contract is assignable. So when we get to the other end of the entitlements to get it fully approved, we actually assign our contract to the builder. And let's say that we're under contract to buy it for $10 million, and we've paid an upfront deposit to the property seller for $500,000. We still owe them $9.5. Well, when we sell the property to Toll Brothers or Pulte or KB or Lennar, or whoever, they will come in with that $9.5 and whatever amount above that we've sold the property to them for, right? So when you say we're buying equity, we're not buying the project. We're not buying the property per se. We're buying the future value of the returns on that capital. So think about it as a return on capital investment, right? Might be an easier way to kind of quantify it.
Well, and since it is an option, the investment is the option's part of the investment, of course. The entitlement and the tradecraft, what you guys bring to the table, is what's being paid for to secure that opportunity. And then, again, you can turn around and then sell that option. Is there a as the deals get, do they get stale after a while? It's dragged on, and you've got to, okay, now you paid $500,000 for the option, but now it's going to be another 125 for another 6 months or something like that?
Yeah. Yes, that can happen. We saw that happen with COVID as an example, right? Two things there. One, when COVID initially happened, we were able to renegotiate every single purchase and sale agreement with all the underlying property sellers at no expense for additional time, because all the cities shut down,
Sure.
For 12 or 18 months before they, so no entitlement work was being done, but we were able to literally maintain 100% of the properties, right? Now, some properties coming out of that became slow movers, right? So when they do get stale, to use your words, and we do have to go back to the sellers and start to, essentially increase their upfront deposit, we have done that for sure. And it works, it gives us more time to get through the entitlement process. It gives the property sellers a little bit more impact, kind of in their financial situation while they're waiting for the final sale.
Is there you mentioned early on, get it as diversified as you can. Would you, in an ideal world, want people to be in as many properties as they can?
Absolutely, 100%.
All right. If somebody comes to you and they invest and they're in 15 deals, bring more money later, are you going to try to complement it so they're in other deals, they don't have overlap, or how do you deal with that?
Yeah, that is what we try to do. Well, it depends on when they come in, right? If it's 6 months later, there might be just a couple, 2 or 3 that they're not in. If it's a year later, year and a half later, there'd probably be another 5 to 10 properties that they can go in that they weren't in at the time they made the initial investment.